Hello everyone, welcome to StudyIQ IAS English channel. My name is Shubham Sagar and today we have to talk about this particular issue. RBI versus government. Something is going on in the background. We will bring that into the foreground. Oh my god, that's stupid. But again, let's focus here. So, should RBI transfer more money to government? That is the basic core issue in simple terms. But this whole issue will also involve some economic terms, which we should know. And these kind of terms have been asked by has been asked by UPSC earlier, and we should be knowing about these terms. What are these terms? One is Economic Capital Framework. BIML or Jalan committee second. Third is contingency risk buffer. Then there are some other terms also. We have to understand the basic meaning of these terms. Let's say economic capital framework, contingency risk buffer, the second word. The third word is Jalan committee, and these are actually important. And then the fourth is the whole issue. What is this whole issue all about? May 17, 2025, Hindu page number 13. So government I have told you in a nutshell, government wants more money from RBI because this is a very precarious situation where we are in. And if you have seen my previous videos, I made a video why is BrahMos in news, where government is investing in more, assembling or creation, or simple terms like creation of BrahMos missile. We need it, cruise missile, and how it can, because we need to spend more on defense expenditure. Government needs more money. Should RBI provide more money? Let's talk about it. Now there are certain things. There is a parallel review going on which is being done by government along with RBI's review of its economic capital framework. What is the basic meaning of economic capital framework? We will understand that. First of all, let's try to see this article. Ministry of Finance is taking an active interest in RBI's review of ECF, economic capital framework, along with RBI is from January. See, understand one thing. They are reviewing their economic capital framework. In simple terms, they are reviewing their balance sheet. And then they are trying to understand how much money, let's say 100 rupees balance sheet is there, how much money they should be keeping it in their contingency risk buffer. So again, it's a long process because it's not like they have 100 rupees in their balance sheet. I have just given you a model example, but they have a lot of money and they have to review it, and they're reviewing it from from January 2025. So almost 5 months. Along with this RBI review of their economic capital framework, just be with me. At the end of this particular lecture, we'll solve 3 MCQs. All the doubts which you have related to what is the meaning of economic capital framework, contingency risk buffer, and other things will be cleared. So 5 months. From 5 months, RBI is reviewing it. At the same time, a parallel review is being going on by Ministry of Finance. They are also reviewing RBI's economic capital framework, according to the author of this article. Now, the question is, the keyword is, there are different keywords. So we'll go one by one on these keywords. First is ECF, economic capital framework. What is the basic meaning of economic capital framework? So as we have just discussed, this is a long process. From last 5 months, RBI is doing a review of their economic capital framework. What are they reviewing? First thing first, how much capital reserve they should hold to safeguard against financial risk. Let's say they have 100 rupees, then should they hold 5 rupees, 6 rupees as contingency risk buffer? There are scenarios like bank run and other scenarios. Bank run is, we have deposited so much money in banks, 100 rupees, 200 rupees, 300 rupees, again a simple example, but bank does not have that much money. Bank may be having, if we have deposited 500, they may be having 100 rupees. 400 they have given it, because asset liabilities, you read about all these things in economy. So if everybody goes to bank, then in that scenario, bank does not have enough money. So this is a precarious situation, a vulnerable situation, where RBI will help these commercial banks. So to ensure, and this is one of the scenarios, there are other scenarios also. So capital reserve, RBI should hold for contingency situations. How much? How much surplus profit can be transferred to government? And government is interested here. They want to increase their dividend. They want more money from RBI, according to the author of this article. Why was ECF introduced? Why this economic capital framework was introduced? To understand how much money RBI should have in their buffer and how much they should transfer to the government in simple terms. So framework was introduced to standardize and rationalize the transfer of RBI surplus to the government. It balances maintaining RBI's you can see here. So RBI has their buffer, contingency buffer. At the same time, government is also doing their work. Like right now, government needs to invest in their defense expenditure, and in that regard, RBI's surplus could help. And many people will see here, Jalan committee, they said that this contingency risk buffer should be around 5.5 to 6.5% of RBI's balance sheet. Now scholars are saying that this was too conservative. Even if you reduce it to 4% or 5%, it's fine. Many people are like, no, this is not done, man. This can lead to a creation of scenarios. This is not done. Like, we should not be reducing the contingency risk buffer rather. Now, there is a question in front of you. Do you think we should reduce our contingency risk buffer? For that, we need to understand what is CRB. We'll do that. So ECF was reviewed in 2018 by a committee headed by Bimal Jalan. This is important from exam perspective. They can ask you what is economic capital framework, but Bimal Jalan committee was associated with what, which particular work, contingency risk buffer is associated with what. So we have to understand the basic meaning of these terms. Committee submitted their report in 2019. Key recommendation, they said that contingency risk buffer should be, let's say RBI has 100 rupees. So 5.5 to 6.5 they should maintain as a risk buffer to deal with different scenarios, and out the remaining money and the surplus distribution can be given to government. So once the CRB reaches the prescribed level, excess capital can be transferred to government. That's what is the point. But many people feel this is too high. It should be reduced. The CRB should be reduced. The transfer should be transparent, rule-based approach. Can they ever write non-transparent, non-rule-based approach? So this is a jibber jabber. Okay, cool. You don't have to write this in exam, jibber jabber. So recent developments. Ministry of Finance is conducting a parallel review. What we have just read, RBI is doing a review of their economic capital framework from January 2025, almost 5 months. Along with that, Ministry of Finance is also doing a parallel review. So there is a lot of interest here. There's a perception that Jalan committee recommendations were too conservative and 5.5 to 6.5% contingency risk buffer is too high. A lower CRB could result in higher surplus transfers to government. See, this is not the first time we are talking about surpluses being transferred to government. If you go back and if you look at the history, you will realize that earlier also this debate happened where some more surplus were transferred to the government. Do you think it is correct, or do you think no, RBI should have an appreciable reserve? And this time and again, this occurrence of where, like, RBI is transferring more and more surplus to government, this is not good. This is not setting a good precedent. Whatever is your view on this particular topic, you can share it in the comment section. So if CRB, contingency risk buffer, is lower, then government can get bigger pie of RBI's reserve. That is what is being written here. Because currently we have to spend on defense, we have to spend on different strategic stuff. So yes, we need, or government needs more money. CRB. So we have seen one term, economic capital framework. So in a way, RBI is checking how much money they have, how much contingency risk buffer they have, how much they should transfer to government, whether they should reduce CRB or not. Now the next question is, what exactly is CRB? Contingency risk buffer, specific component of economic capital maintained by RBI. That is, see, understand one thing, if you have to understand it in a simpler term, economic capital framework is a superset, and you can say that contingency risk buffer is a subset, because this is one part of economic capital framework. When RBI is reviewing their economic capital framework, there are other things also which they are taking into consideration. That's why they're taking 5 months, and it has been almost 5 months from when they are reviewing it. So this is just a subset. This is just one important component, but this component is the pie, or is the component where RBI and government, they are, they both are very interested in the CRB. So it acts as financial safeguard against unexpected risks. I've told you bank run, that is one risk. There are so many other risks which can happen in an economy as big as ours. So what are those, unexpected scenarios? Financial market volatility. Oh my God, this is actually a tongue twister. Volatility. And there are different things. We read about FDI, foreign direct investment. We read about FII, foreign institutional investment, which is also foreign portfolio investment, which is very volatile. So like FDI is stable, somewhat stable, but FII, FPI, they are very volatile. So this can lead to one, financial market volatility, economic crisis, exchange rate fluctuation, $1 equals to this rupee and that rupee. So there are so many scenarios for which RBI has to be ready, and CRB helps in that regard. Contingency risk buffer. Cool, sir. So CRB concept, again, we have talked about this. Jalan committee, Bimal Jalan committee, they gave this particular benchmark 5.5 to 6.5%. And again, as we have continuously talked, that many people feel this is too conservative. Government feels it is too conservative. We can reduce it. If we reduce it, there will be higher surplus which can be transferred to government, and government needs it in this particular time where government is spending more on defense and strategic expenditure. So recent relevance, we have talked about all these things. Ministry of Finance is doing a parallel review along with RBI reviewing economic capital framework. One of the component of this economic capital framework is contingency risk buffer, and many people feel CRB should be reduced. So what is your view on this? Do you think CRB should be reduced? Do you think CRB is too high, or you feel no, whatever amount is there, 5.5 to 6.5% of RBI's balance sheet, that is actually a good amount, we should not be reducing it? Whatever is your view. Let's say you are an economist, you have economy optional or anything like that, you have done graduation in economy. So if you have any views on that, you can, even if you have not done graduation in economy, if you have any view on that, you can share it in the comment section. First MCQ in front of you. Contingency risk buffer is what? Special reserve fund created by Ministry of Finance to manage budget deficit, fund allocated by RBI to absorb any financial or economic shock affecting financial stability, a reserve maintained by commercial banks for meeting NPAs, a contingency fund used by state governments for natural disaster. Second, MCQ2, Jalan committee is associated with what? FRBM, reviewing FRBM Act, B, reviewing direct tax code, C, reviewing RBI's economic capital framework, D, suggesting changes to monetary policy transmission. MCQ3, which of the following is our possible implication? This kind of question has already been asked by UPSC, even the previous MCQ 1 and 2. So please try to solve all these three and try to ensure that you are getting all the three questions correct. So what can be the implications if RBI reduces contingency risk buffer, which many people want, many people in government as well? So higher surplus can be transferred to the government. It may increase fiscal space for government. Financial stability of RBI may be strengthened. What do you think is the answer? If you know the answer of these questions, you can post it in the comment section. I will share this particular PDF along with the answer of all these three MCQs in my Telegram channel, Fun Study with Shubh, because study should be fun. Very good. Okay. Yeah, Fun Study with Shubh. You can join this Telegram channel. You can be a part of my family. At the same time, if you're preparing for UPSC 2026, do join our May evening batch, and batch has just started. You can use my code SHS Live to get maximum discount, and it includes Prelims and Mains Residential Program. If you clear UPSC Pre 2026, you will get full refund. 11,000 reward will be given to monthly top performer, and it also includes interview guidance program because this is P2I, Prelims to Interview. So whatever are your views on this particular topic? I have asked you three MCQs. If you know the answer of any of them or all three of them, you can post it in the comment section along with your views on this particular topic. Very important topic if you talk about economic standpoint of India. So yeah, important. So if you have any views, feel free to share it in the comment section. I will see you soon. Take care. Be blessed. Tata. Bye-bye.